as well. But let's shift focus to our special segment, Insight Edge, where we get you, the insight coming in from what the management spoke to us as well. Nigel joins in with the key takeaways from the management commentary of Shree Cement and why the stock is higher despite weaker numbers. Nigel.
Well, the numbers were a little bit weaker of Shree Cement, but it seems that positioning was such that the street was expecting a bit of a subdued set of numbers coming in there. And in terms of the miss, it came on the EBITDA front. The EBITDA missed our estimates by close to around 4%. Margins as well, we were working within the vicinity of around 20% odd. It came in a little bit lower than that. And the reason the profitability is higher because of a tax credit. Now, what has the street read positively? We spoke to the management here on CNBC-TV18 and there were a few big takeaways. One was on volumes. Remember, they have been expanding capacity both in northeast of India as well. And they are saying that they'll grow by around 12 to around 13%. The industry could grow by around 8 to around 9%. So they'll be growing at a faster clip. They'll end this year with volumes of close to around 35 to around 36 million tons out from around 32 million tons. So that's a decent growth that we're looking at. EBITDA per ton, they said there are many factors that are playing out. Input costs, there's volumes, there's cement pricing, which has been more or less stable. But they are saying that they couldn't give us a fixed number, though they guided that it's on an improving trajectory from year on. So that's a positive read-through. Premium sales, remember, they were quite, in the low single digits. Now they're saying that as of current reckoning, it is at around 7%. By the end of this year, it could double to around 13 to around 14%. And in the next couple of years, that's by 2025, 2026, it'll go to nearly around 30%. You'll say, what's so great about that? Well, it helps the EBITDA per ton by around 40 to around 50 rupees per ton. And finally, in terms of growth, well, we quizzed them about inorganic growth, whether or not they're interested in Sanghi Industries. They didn't comment on any particular asset, but they said they'll do what is accretive to the company itself. And they've also mentioned that that target of around 80 million tons by 2030, well, that will be totally by organic growth. There's no inorganic growth that they've considered as of now. In fact, let's hear out what Mr. Neeraj Akhoury, the MD of Shree Cement, had to tell us earlier today.
Be growing in the range of 12 to 13%, where our market growth outlook is about 7 to 8%, slightly ahead of the market growth, but largely because of new capacity additions that will come. With this growth, we should reach somewhere around 35 to 36 million ton this year. On EBITDA, I think we all know that there is a trend of softening of the fuel prices. That's a bit of a tailwind that we are experiencing. And therefore, if everything remains stable, including the realizations, I believe directionally we will be in a positive zone. We are keen to look at some of the opportunities which will come up in the market. But at the same time, we are very focused that such a step, such an acquisition should add value to our company, but at the same time should also be part of the strategic growth fit that we have. And that's how much I will comment. I will not go to specifics about any target at this moment. I think it's too early. But if it meets our criteria, surely we are not against inorganic growth. 80 million ton is a pure organic target. We have several places where we plan to expand our footprint. So 80 million ton will come from purely organic growth that we have planned and we are putting into execution now.
Okay, that is the word coming in from Shree Cement's management, looking very